Hey, Scott.
You managed to have a pretty good year in the face of some pretty severe headwinds. So you've listened to the commentary here from our committee. As an outsider who's listened to what's happening in the room, so to speak, what's your view?
Yeah, I mean, Shannon just started to get right into the heart of the matter because Steve's right. When you don't know the earnings, when you have higher terminal rates, there's going to be multiple compression. It lends itself to the game of, well, where's the S&P going to end at the end of the year? Let's put a number on it. And that's certainly fun to do, especially this week at the beginning of 2023. But the problem is, Scott, it doesn't make us any money. We need to identify opportunities each and every day, regardless of what's happening. The Fed will go too far. They'll be too aggressive, just as you've implied. They're okay with the recession. They're all of us collectively are hoping that will be shallow and short-lived and we can be out of it because there is no pivot until there's a recession. So the Fed's saying 5.4%. It wouldn't surprise me if we start hearing rhetoric saying 6% at some point, because you really need to drive the point home that inflation has to be tackled before we can think about a pause or a pivot. It doesn't mean they need to go that high, and certainly the bond market doesn't think that that's going to be the case. But from my perspective, kind of listening to the conversation, you bring up some really good points that we don't know exactly what's going to happen. We've got to put a little bit of faith into the conversation, into the mix. But at the end of the day, we need to find companies that can perform in a recession, in an inflationary environment, regardless of what's happening with the broader economies. And that's why the summit's so exciting.
See, there are investors out there who are probably thinking to themselves, stocks came down 20%. Kev, I mean, I'm not going to be able to pick the exact moment, but if I'm in it for the long haul, why shouldn't I buy some stocks here in the environment that we've just gone through? And I pose that question to you rhetorically, in a sense, because you've done it with Apple, for example, which is one of those stocks right now that is arguably in that key battleground area, right? The stock's been hitting new 52-week lows on an almost everyday basis. It's up slightly today in what is an overwhelmingly down tape. Why Apple? Why now?
Well, I think to your point, it's almost impossible to pick exact bottoms. So with our trade on Apple, and you and I talked about this just 2 months ago, we had the entire position called away, which at the time didn't look all that brilliant because I think it went up another 10 points after we had it called at 157.5. But once it rolled over and has come back into the 140s, into the 130s, you have to start looking at this as an opportunity. The PE is still at 20. So if you're thinking about multiple compression, to Steve's point, the stock price has to come down because the multiple's not going to go up. But looking at this as an opportunity to start building a position, and we've now reaccumulated about a 1.5% position in Apple with a target of getting it back to that 5% level. Internally in our shop, we're saying if it gets down to 110 to 115, like that to us is very, very attractive. But it may get there, it may not. So what we're doing is, old school dollar cost averaging. We've got a very patient approach to every position that we own. And I'm sure we'll talk more about some of the others later. But with respect to Apple, you can start looking at it, but you have to definitely anticipate that Apple, as well as the broader markets, can certainly be lower before we get an all clear signal and we're celebrating the next bull market.